Conversation forward with Dr. Marc Faber. He joins in on the show to chat about what he's making of the market. Marc, hi, afternoon. Good to chat with you as always. And you were one amongst the brave ones who were saying last week itself that buy this decline. And it seems like, at least for now, looking at how US has panned out, Asia, or for that matter, India, finally those traces of green are coming back on the screen.
Well, yes, you're right. Stocks are up, but considering how much they declined in the last 10 days, and, from the high to the low in just 10 days, Tesla has dropped 33%. So if it bounces back 10%, we're still down more than 20%. And I think investors should understand, I don't believe that the coronavirus is causing the sell-off. I think it's a catalyst for a sell-off because the global economy was weakening already a long time before it occurred. In other words, for the last 9 months, the economic statistics coming out of Asia have pointed out to a meaningful slowdown in economic activity, and in some cases already actually an absolute decline in many sectors, in many industries. We've been going down for the last 9 months, and the kind of coronavirus is the icing on the cake that really knocked markets down. And the question is not, of course, today for investors, do you buy or do you use any rebound in markets as a selling opportunity? And my take is that investors who are overweight stocks, and by my standards, overweight stocks is to have more than 25% of your money in equity markets. For these people, I would suggest use the strength to lighten your position, because the markets are not cheap by any standards. Sometimes experts tell you, well, after SARS, the markets went up. Well, I'm sorry to say, in 2003, the Nasdaq had declined by close to 80% from the high in 2000. So the market was at a totally different juncture in the market cycle than it is today. Today, all markets are in the sky.
Yeah, absolutely. You make a valid point there that the texture of world markets was very different back then. And even the point that you were saying that, coronavirus is only at best a trigger for overheated markets, because even if you look at India, we're pretty much in the same boat where valuations are really high. It's a market which is very restrictive, 10 or 15 stocks holding up, taking the indices higher. So we're somewhat falling under our own weight as well. But the point is, Marc, where does money find its way then? If you're recommending lightening positions, even for those having 20 to 25% exposure in equities, where do you park your money then?
Yes, you're making a very good point. We need to call the central bankers that created these artificially low interest rates, where especially young people, they are faced with the dilemma of not having an incentive to save, and what they want to buy, a house or other goods, they're all very expensive, you understand? So that creates this wealth inequality, which then leads to politicians like Mr. Sanders in the US that have a wide following, but basically they're socialists. And specifically to your question, if I were living in India and if I had an Indian passport, which I don't have, so I can't buy really properties in India, but I think selectively, and I want to explain what I mean selectively. You see, in the city centers, commercial properties are very expensive. Or if you want to buy a house in the center of Mumbai or Delhi, it's very expensive in a good location. But the world is changing. As you know, already now, many companies have been asking their staff to work from home to no longer come to the office because of the risk associated with the virus. And this, I think, is the long-term trend that many companies will have no more offices. Their employees will all be virtual or cyber employees. In other words, they'll work from their homes. And once you work from your home, you can live in the middle of nowhere. You can live in the countryside where property values are still very low compared to the city centers. And I think that is a trend. And I think actually that this is very negative for commercial real estate prices in financial centers.
Just talk about what's happening with commodities as well. What would be your view on commodities? Do you think some of the commodities, the way they have collapsed, are just showing that the economic activity itself will come down?
I think it's quite clear that if you look at the freight index, the Baltic freight index, if you look at industrial commodities, if you look at the performance of equities that are tied to commodities, then the outlook for the economy is from the perspective of the market. In other words, the market is telling you something is not doing well. Now, some commodities have been going up and some commodities are not so sensitive to the cycle. Say agricultural commodities are not so sensitive to the cycle. But considering everything that has happened, they are not performing very well. But they are cheap, that undoubtedly. Now the precious metals, they were very strong until essentially 3 days ago, until last Friday. And then they also collapsed. And I think the correction in precious metals could go on for some time. But coming back to the question, what would you do with your money? I would say, I think it's quite okay in the long run to always keep some of your money, some of your funds in precious metals.
Yeah, absolutely. And, much of the year gone by has taught us that it makes sense to park your money in gold. But Marc, if you had to make a portfolio allocation out of $100, how much would you allocate to equity for, say, the next 3 to 5 years if you are in India, having an Indian passport? I know you talked about property and property in offbeat locations, but as a percentage of your portfolio, how much would you allocate to real estate assets right now? And how much to equities and how much to gold?
Well, first of all, I think I would not overlook the bond market entirely. Because let me give you an example. Switzerland issued a while ago 10-year bonds at zero interest rates. In other words, it's a zero coupon bond at 100. Okay, so you can buy these bonds, and for 10 years you get no interest. You're betting essentially that the interest rates go negative or that the Swiss franc becomes very strong. So anyway, these bonds, yesterday, they traded up to 115. In other words, you bought them at 100 and now they're 115. So although they pay zero interest, if you bought them today at 115, over the next 10 years, you're guaranteed to lose 15%, guaranteed, okay? But some people still buy them because maybe they think to lose 15% is not as bad as to lose 80%, which investors in Swiss banks have done over the last 20 years. So, the market is full of strange things because the market prices have been distorted by the interventions of central banks. 2 years ago, Austria issued 100-year bonds, okay? So you buy a bond for 100 years and the interest was 2.25%, 2.25. The bond was issued at 100. nobody wanted to buy it, but this bond went to over 200 from 100. In other words, I would look at bonds as well, because over the last 12 months, in long-term US treasuries, you made much more money than in stocks. And so my allocation would be 25% in equities and probably around 50% in real estate, and then about 25% in precious metals, and about 25% in bonds. Now, I know it doesn't add up, but no government budget adds up. So I also take the liberty to have an allocation that doesn't add up.
Point. We'll give it to him on that one, right? No government math and budget ever adds up.
Right. So, Mark, when we just talk about the US markets for last few years have, continuously hit new highs. With the velocity of the fall, the way you said Tesla has fallen, some of the other stocks, large cap stocks have seen such brutal amount of selling. What does it tell you about the market cycle? Are we coming out of that big bull market from the US?
Well, I think this is a very good question, which I addressed a little bit before, in the sense that I said we're at a different stage of the cycle than in 2003. In 3 days, actually in 2 days, the bull market in the US, which began on March 6, 2009, with the S&P at 666, will be 11 years old. The economic expansion will be in June 11 years old. So we're dealing with a market that is very mature. Now, I've written about this, but now I also saw an academic study on the subject. When I started to work in 1970 on Wall Street, there was the beginning of a very heavy concentration of money in just a few shares. We called them the Nifty 50. These were shares like Kodak, Polaroid, Sears, Penny, Xerox, Boros, Digital Equipment, IBM, and so forth. Most of them have disappeared, actually, but at that time, the institutions put all their money into these stocks because the saying was, no matter what happens to the economy, these companies will continue to grow. And today, we have an extreme concentration of money into a handful. I wouldn't necessarily call them technology shares because some aren't, but they are the momentum stocks. These are semiconductors, Google, Amazon, Apple, Tesla, and so forth. Normally, they are included in the so-called New York FANG index. And you can, there is a symbol, and you can measure this or watch the prices of this FANG index every day. And these stocks, they have attracted the bulk of money. Some people will say it's because of indexation. I'm not sure that I buy this argument. I rather think we have a very narrow leadership. It's like you said earlier, in India, some stocks are very expensive because they are perceived to be high quality. So they're selling at 40, 50 times earnings. And other stocks, obviously in India and in the US, are very inexpensive. I mean, you want to look for an inexpensive group around the world, look at oil stocks. The energy sector is very, very depressed. So you have this dichotomy in the market with some stocks being very high and some stocks being very low. And this leads to the question, not only how much do you put in stocks, but in what kind of stocks. So the debate is between the value investors, because the value stocks have underperformed the growth stocks, for the last 10 years or so, since 2009, 2008. But in many instances, value outperforms growth for a very long time. So these are issues that are not so easy to answer, and we don't know ahead of time. My impression is that the returns from stocks will be very low going forward. I think in real estate, the returns will also be relatively low. But as I said, in selected locations where you can actually add some value, if you buy a house in the countryside somewhere and you get a few other people to also build nearby you, and then you develop the infrastructure and so forth and so on, you can add value. That is more difficult with buying equities for the small investor or medium investor. And as I said, I would invest some money in precious metals because I think it's inevitable, in my view, that the central bankers will continue to print money. And I think it's wrong, and it's led to a lot of problems, but they'll continue to do it.
The other thing, Mark, I mean, would the US dollar as well appreciate as opposed to emerging market currencies? And should you have dollar as well as some part of your portfolio?
Yes, again, this is for me a dilemma. I think the US dollar is basically overvalued. But for now, against emerging market currencies, it's likely to continue to appreciate. As you know, the Indian rupee has been a little bit weak recently, and some other currencies. The Brazilian real is down 10% this year, as well as the South African rand. It's also down very substantially this year. I don't have the figure right in front of me, but also in the order of 10%. So I think that the currency aspect is important. I have some money outside the US dollar in Swiss francs and in euros, and especially in Singapore dollars. But for me, the best currency relative to all the other currencies is essentially gold, silver, platinum.
Okay, Mark, what a pleasure having you on the show and, getting in some interesting ideas and views from you. Good to speak with you as always.
I'm not sure it's a pleasure, but thank you for the interview.
Okay.
Bye-bye.